Welcome again to Vinac Resources, and today we are going to show you how to record transactions in a T account or in a ledger account. Let us look at the background of T accounts. They're shaped like a T, that's why they're called T accounts. They are recorded on a ledger account. They have three main parts. You have the name of the account on top, then they have the debit side on the left and the credit side on the right. Let us look at the overall process of a transaction. It starts as being recorded in the journal entry, then it goes to the ledger account, and lastly, those balances in the ledger accounts are used to make the financial statements. Today, we are looking at the ledger accounts where we have the T accounts. Let us look at the simple format of a T account. It looks like a T, and on top it has the name of the account, it has the debit and the credit side. Let us look at some of the key facts about the T accounts. They're simple and straightforward entries that are used for quick instruction purposes. They show an understanding of how a transaction can be entered in a general ledger where it's either debited or credited. And lastly, we can say that before making a T transaction, always remember that the transaction must first be entered in the general journal where it's then transferred into a T account where it's grouped into the respective accounts. As we have said, you cannot have a T account without first having a journal entry. So this is a journal entry and it has 6 transactions. Those transactions are then recorded in different accounts, as you can see in the third column about the accounts name. Then we have the debit or credit sides where those amounts are credited or debited to. So this is a sample of a journal entry, and we are going to use this information to make T accounts. So let us start with the first transaction. You can see that's the ledger account over there, the journal entry over there. So we make our inventory account. We have the debit and credit side. Then we say on 10th, goods were bought for 500,000. There's a total of 500,000. On the credit side, there is no N entry. That's a zero. Then the balance is 500, meaning we have 500 from the debit side. We have 0 from the credit side. 500 minus 0 is 500,000. So we have 500,000 being there's the balance plotted down on the debit side of this inventory account. This assumes the fact that from previous years or records, we didn't have any balances that were put down. Let's go to another transaction. We have the journal entry over there. Then we have the account receivable, debit and credit side. On the 20th, good was sold for 45,000, recorded on the debit side. The total for debit is 45,000. We don't have any credit recordings for accounts receivable, so the total over on the credit side is 0. Then the balance is 45,000. That is 45,000 on the debit side minus 0 on the credit side, getting a total of 45,000. on this account receivable. Now let us look at another set of transactions and the example in the T accounts. Let's look at these four transactions that affected the cash accounts. We have the cash accounts, T account, where we have the debit on the credit side. On 15th of January, goods were sold for 55,000. On the credit side, equipment for 35,000 was bought. A loan was paid for 50,000, and the salary was paid for 35,000. On the debit side, we have a total of $55,000, and on the credit side, we have a total of $120,000. The balance will be minusing the debit minus the credit side, which is 55,000 minus the 120,000, which brings a balance of negative $65,000. Let us move to the next transaction, whereby there was a purchase of equipment for 35,000. Equipment account, we have the debit and credit side of a T account. Equipment was bought on 25th for 35,000. The total was 35,000. Total on credit was zero. Nothing was recorded there. So 35 minus 0 on the credit side is 35. So the balance is usually for the equipment, which is an asset, is on the debit side. So we have a balance there as 45 as $35,000. Let's move along to the next, the salary expense that was done on the 30th, paying of employee salary. The salary expense account, the T account, we have the debit side, credit side. Then on the 30th, we have salary of $20,000 paid, total of $20,000 paid. Credit side, that was nothing, that's zero. The balance becomes 20,000, that is 20,000 on the debit side minus $0 on the credit side. It becomes a balance of $20,000. Let us move along to the next journal entry about accounts payable. Our accounts payable, we have the debit and credit side on the T account. We have recordings on the credit where we have purchases of 500,000 on the first day on the 10th of January, 50,000. Then there was payment of that loan for 50,000 on the 27th. The total on the debit is 50,000. The total on the credit side is 500,000, and the balance will be 500 on the credit side minus the debit side 50,000, which brings a balance of $450,000. So this is the loan that this organization has to pay. So it had a loan of 500,000 in the beginning, then it had to pay 50,000, then it's left with 450. Simply that's how you can read that accounts payable recordings. Let us move along to the next set of transactions where we have the sales revenue account. It was affected by two transactions, as you can see up in the journal entry. Then we have our sales revenue account, debit and credit, sold goods for 55,000, then sold goods again for 45,000. Totals on the credit side is 100,000. Totals in the debit side is zero. The balance is 100,000 minus $0 on the debit side. So we have a balance of 100,000, and usually the sales revenue, normally the balance is recorded on the credit side. That brings to the end of our presentation. If you have any comments and questions, please reach out to us. Also, please subscribe to our channel at VNAC Resources. Thank you